Well, second quarter saw continued market volatility as we continue to hear more about trade tension and Fed policy entered into the equation as well. Welcome to our quarterly update. My name is Brad Kelly, Director of Eide Bailly Financial Services and Wealth Planning. Joining me today, as always, is Darren Pladsen, Director of Investment Strategy with Eide Bailly Financial Services. And a special guest today is Andrew McDermott, who's tax partner in our Spokane office and soon to be a financial advisor within Eide Bailly Financial Services. So Andrew, welcome.
Thank you.
Darren, let's just start off with just a high-level summary of second quarter and just some of the observations that we had.
Yeah, second quarter, again, Brad, was very strong, similar to the first quarter. A little hiccup in May, but June responded very strongly. Bond market looks very positive right now also, and even international markets are very strong right now too.
You know, the last time that we met together and did an update after first quarter, I think the phrase that we used was cautiously optimistic. We talked about the headwinds that we had seen last year. We weren't seeing as much this year. Would you say that we're still in that position now after second quarter?
Yeah, I think so. I mean, you know, we're seeing data all the time, and it's so interesting. We go from quarter to quarter, and you know, the market, the landscape's always changing, right? And so whether it's inflation or unemployment or all these great charts that we talk about, they're always changing. But right now, I'm still in that mode of cautiously optimistic.
Yeah, and so we look at the data and the numbers. Yep. Andrew, you're talking to clients on a day-to-day basis. Just high level, what are some of the general themes that you're hearing from clients as you're visiting with them?
Well, and you know, all of our clients are busy running their businesses, so I don't know if it's looking at numbers and data the way we do, or certainly you two do. But I think there's an optimism about the next 12 months, maybe 24 months in terms of looking at what's ahead of them. But everyone understands it's a cycle, especially when the entrepreneurs and the privately held businesses that we deal with. And it feels like we've been, or what I'm hearing, we've been in a real upcycle for a long period of time. So there's a little bit of nervousness about, well, when is this cycle going to change?
Right, exactly. I mean, we're 10 years plus in an expansion mode. And so I think that is that general feel. Even though we're 10 years past the last crisis that we went through, it still feels pretty raw to us and I think our clients as well. So I think everyone's thinking, how long can this go?
Mm-hmm. Yeah, and I talk to clients a lot about just that, and usually, and we'll talk a little bit about kind of recessions and what's going on there. But you need some sort of boom. Or a bust from a boom, right? And right now I'm not seeing it, and we'll talk about like cyclical sectors today, and those are really the drivers of, say, GDP, which by definition, I mean, that's, you know, a couple of negative quarters of GDP will typically create a recession. So right now, I'm, again, fairly cautiously optimistic, and I'm not seeing any real crazy boom going on right now, anyway.
Well, speaking of GDP, let's get into the numbers, and let's start with GDP and economic growth. So what are we seeing?
You know, first quarter of 19 was pretty strong. It was at about 3.2%. Quarter over quarter, that's year over year. Quarter over quarter was about 3.1%. The forecasts going forward are actually going to be probably about 1%. So it's going to drop a little bit. And there's a couple of reasons, quite frankly. If you look at the right side of that chart, investment ex housing has softened a little bit, which makes up a fair chunk of GDP. The other part is inventories right now. Inventories have grown, if you think of it, there's a lag in inventories all the time, and they've grown. But what's unique about inventories is they always revert back to the mean, and they usually do it within a couple quarters. So, you know, throwing numbers out there that may or may not mean something, right now they're averaging, or the number is about $123 billion of inventory out there versus typically about $41 billion. That'll come back, but that's going to hurt growth going forward, especially in the next 2-3 quarters. But even into fourth quarter of this year and going into next year, that should revert back to the mean. So I don't see a real boom and bust situation there.
Okay. All right. Andrew, I mean, just as you talk to clients, I'm assuming especially with your closely held business owners, they've seen growth over the last several years. Are they anticipating that continued growth as we go forward? Are they being a little more cautious as far as forecasting growth? forward?
Yeah, I think for the most part, everyone feels really optimistic about where we're headed. I mean, there's certainly some things that are have privately held businesses and small businesses nervous, and we'll probably get to this. Labor is on their mind in terms of, hey, do we have a shortage of labor? How do we keep good people there? I haven't seen inventories with our clients, and we're in Spokane in the Pacific Northwest. I haven't seen inventories going this way, but that's an interesting trend to have that conversation with clients, and is that happening? But I think for the most part, when we look out 12 months, 24 months, people are really optimistic. We've got an election coming up, and some other areas with the labor and interest rates that have more sophisticated business owners a little nervous, and like you guys use the word cautiously optimistic. I think that's where at least we are at in the Northwest.
One more point, Brad, about that slide. If you look at the right side, the consumer makes up a large part. Very strong right now. And you talk about, logically, what's the consumer going to do? They're getting extra money from this, the tax bill here from a couple of years ago. They typically put that back into the economy, hopefully lessens inventory. So kind of circling back with that too.
Yeah. Let's go a little bit deeper, and let's look at some of the sectors in the economy. So what are you seeing from a sector standpoint?
Yeah, so these the cyclical sectors, they're the main four drivers, and they combine for about only 21% of GDP. But they account for 66% of the volatility. So when you see these sectors, the trend up and above maybe an average line, it might be something to kind of be aware of. But you look at all four of them: residential investment as a percent of GDP, business fixed investment, private inventories, and motor vehicle sales. They're all relatively in kind of that safety area. And again, you need a boom with a bust. But you go back to what we were talking about. Expansions really, they don't just die. They need to be killed by something, right? And so I'm not seeing that. And these sectors are, I think, kind of show you just what's going on out there. So,
when we get into sectors, do we see any particular sectors that are overvalued, kind of bubble type concepts there?
I think it kind of goes back to inventory, maybe a little bit stretched right now, but I think that's going to revert back. And I out of these four right here, I'm not seeing anything
that's
crazy.
Extreme.
Yeah, housing isn't, autos isn't, so.
How about you, Andrew? I mean, with the various types of clients that you work with, are there certain sectors or businesses that you're seeing that are having more growth than others, or does it seem to be fairly widespread?
Well, I mean, we do a fair amount with contractors and real estate developers, and they're very busy. I mean, so you look at it from the business standpoint, and when they're building, whether it's commercial or residential, they have a big backlog, a lot of growth in our area. Where we're at, Eastern Washington, North Idaho, Western Montana. So we're seeing a lot of movement of businesses from the I-5 corridor, from Seattle, Portland, San Francisco to the Spokane, North Idaho area, in part because cost of living is much lower than those areas. So we're seeing a lot of growth. And when we look at the housing areas, I mean, what I understand is in that $200,000 to $400,000 area for a home, they're going like hotcakes. You get some of our clients that are really high net worth and have homes that are in $1 million or more. They're sitting on the market. So the developers, contractors, very busy in terms of just getting people into Spokane, North Idaho, and finding homes for them in terms of the people you need to do the work. That's also a challenge in terms of finding affordable housing. So,
it's just to continue on that. It seems like as I travel around to offices in different markets, it feels like that mid-level home sale, that inventory is moving at a fairly rapid pace. You get up into the higher level homes, not so much so, but that probably signals pretty strong economy, right? If you've got the widespread consumer activity that's real positive, I would think is significant to growth going forward, right?
Yeah, and I in the smaller communities, Fargo and Aberdeen and Sioux Falls versus big metros, I completely agree. I think that mid-level housing type of market is still very, very strong. The higher ends, you take out a portion of the population too, but that mid-level seems very strong.
Yeah. Yeah. In fact, just to kind of go a little bit deeper there, the REITs that we have in our investment portfolios have really performed quite well this year. Both U.S. and our international REITs as well have been significant contributors to return.
Right.
Within our portfolios, we have a sector momentum strategy that we launched about a year and a half ago, I believe. And that rotates based on formulas and disciplines that we have every quarter. Where are we kind of emphasizing right now in our sector momentum strategy? What sectors?
Well, technology's been, it's quite frankly been the driver of the market for probably the last 2 or 3 or 4 years. The FANG stocks, I talk about those quite a bit. Real estate's been extremely strong. That's been, I believe, in the last at least 3 quarters, been in that sector momentum. And it's kind of interesting because you think of like utilities, kind of a defensive nature type of holding. That's been in our sector momentum. And then, one of the other ones that's been in it quite a bit is consumer discretionary, which means, boats or hot tubs or things that people have discretionary money to really spend on. That's been a great sector too. So those have kind of been the 4 drivers. It is rotating again here, Brad, in August. So there's going to be some movement there, but, to be continued, I guess.
Right, exactly. Do you have a boat or a hot tub? Both?
I have a boat, and I can attest they are more expensive than they were 25 years ago.
Yeah,
so,
exactly.
Right.
Yeah.
We don't have too many hot tubs up in the Dakotas, although you do see them every once in a while. All right, so moving on, let's look at just long-term drivers of economic growth and kind of dig into that a little bit.
Yeah, and we've been on this, topic GDP for quite a while. One more point that I just want to make is the potential for a limited number of workers. And if you look on the right-hand side, the drivers of GDP growth, you have growth in workers, which is a big part of it, and then you have growth in real output, and that's how you add up GDP. And if you go to the upper left-hand slide and the forecasts, and I'm not trying to talk politics or anything like that, but immigrants versus native borns, right now we're not having as many children as, well, maybe not us, but the next generation, right?
I know I'm not.
Well, I'm not either.
Yeah. Andrew?
I think I'm done.
Okay.
But that generation just, the families are getting smaller, therefore we need more workers. And so this gets, a big hot topic of immigration, and again, not to talk that politically, but that could be a potential problem the next 10 years. Go back to the history of Japan, right? In the 90s, the age of their country grew and grew and grew. It didn't fill in from the bottom, and they've been in I hate to say a 20-year recession, but the growth in Japan has been very, very bad because of the age of the population. Yeah. So could be a fear, could be something, we just keep watching.
I think go ahead.
Oh, sorry. We're seeing that with our clients in terms of there is a labor shortage. I think where we're at in Washington State, right on the border with Idaho and Washington, we see a flow of Idaho folks into Washington because the minimum wage is higher. So we've been a little bit insulated where we're at, but it's an issue in terms of hey, how do we get good labor? Yeah. And I think some of our clients are nervous about not having adequate labor. Could that translate into a recession at some point or cause a recession?
I think it could. And, if you flip slides there, Brad, the next slide is really unemployment and wages and wage growth or lack of wage growth. We're seeing wage growth kind of max out and even unemployment troughing here. So I think those are big risks, especially out the next 10 years. I don't see anything, issues for the next, say, 12 months or anything like that. But I think that could be a drag on the economy from a growth standpoint. And, if we're muddled in this 1% GDP, when does that catch up to us? Yep. And so, yeah. Right.
Yeah, so, you were just talking about the demographics of our country. And recently at the partner meeting, the Eide Bailly partner meeting in Salt Lake City, we had a speaker that talked about that topic. And again, from a non-political standpoint, just the numbers are the numbers. And so if you look at the aging of our population, you look at the millennials coming in, immigration, all of those elements coming together certainly will have some type of impact on us over the next 5 and 10 years. What that is, I'm not sure, but it certainly will drive and have some kind of impact on our economy.
Yeah, absolutely.
So unemployment's coming down, wage pressure. What are we seeing with wage pressure right now?
Wage growth, and I look at this slide a lot, and it appears they're both kind of bottoming out. So unemployment should bottom out. What's interesting, you look back historically, back to the 70s, and when unemployment bottoms out, it typically takes 2 or 3 years. It just sits there and it doesn't move. Then we see a recession or something of that. It could be sooner. I'm not saying 2 or 3 years with the recession, but and then unemployment's going to go up. So it's going to ebb and flow. Wage growth looks, I would say not as strong as like a lot of economists maybe anticipated would happen, but kind of the same thing where they're kind of touching each other, as you can see on the chart, and how long until it just muddles, and then wages maybe will come down, unemployment might go up.
Yeah.
But typically that is kind of it won't equate to a recession, but you'll be seeing a recession when both of those start going away from each other.
Yeah. Okay. One thing that I have found very interesting over the last several months and actually last couple of years as we've given the update is that we keep talking about growth, the market keeps going up, but yet we're really not seeing inflation to the degree that maybe you would anticipate. Let's just talk a little bit about inflation.
Right.
What are we currently seeing there?
Yeah, if you look at like headline PCE deflator, and it's really a bucket that they're measuring it by, and it's a rotating bucket, so it's actually a great reading. The May reading was about 1.5%, and then core, which is taking out food and energy, it's at 1.6%. If you look at the Fed, and really they're mandated by employment, inflation, and then they forecast what they think is going to happen from a Fed funds rate. But their forecast is at 2%, their long-term forecast. They're right in the wheelhouse. They'd probably like inflation to go up a little bit right now. But even, you go back to wages, that previous slide, wage growth, it's not inflationary right now. I mean, it's moved up, but it's moved up within a normal range.
Yeah.
So the Fed's sitting in a great spot. I mean, they're sitting, and whether they hold still or they increase rates or lessen rates, and we'll talk about that really soon. They're in a great spot.
Yeah.
They're managing this. I wouldn't say perfectly, but I'd say they're managing it fairly easily.
Andrew, with regard to clients who own businesses, are you seeing revenue profits going up? And if so, what are clients doing with their profits? What are they doing?
Well, yes, I mean, we are seeing a lot of folks that are generating more revenue and net income than they have in a long time, or at least in our area. And I think that's true across the country. It's interesting. A lot of our clients have started accumulating over a period of time a lot of cash. That are either reinvesting in the company, holding it as working capital, or distributing it to themselves. But it's not directly related to inflation, but a little bit. We've seen some return on cash lately. I mean, so where it used to be an expectation of almost zero as it sat in the bank, you can move it to a money market now, and so and earn maybe 2.3%. So our clients that have $300 million of working capital, just being smart about how they're using, where they're putting their cash, because it's a pretty material number if you can earn 2.5 or 2.3% versus zero.
Right.
So I think we've been trying to help our clients in terms of being smarter with that, and I think they appreciate that side of it. But I think it's a good time to be in business in the United States.
Yep, I agree. So, we'll take a quick break here. And Andrew, thank you for joining us and just providing your thoughts and insight. We really appreciate you doing that. So we will take a quick break and come back with another guest. Well, welcome back. We have now joining us Ryan Weigel, financial advisor from our South Dakota offices. Ryan, thank you for joining us.
Thanks for having me.
And I think we'll pick up the conversation. Let's talk a little bit about just the momentum around manufacturing from a global perspective. And Darren, take us through this slide and tell us what we're seeing.
Sure. In a nutshell, this goes back to 2008. Red is bad, yellow is okay, green is good. And you can see we've had quite a shift over the last really 12 months from 2018 where everything was green. Now we've got kind of red and orange and a lot of yellow. Mm-hmm. And the defining part of that is tariffs. I mean, it's just a whole bunch of uncertainty throughout the world, and people are fearful. Countries are fearful. Even people in the U.S., quite frankly, are a little bit fearful. So you're just seeing a little bit of muddle through right now. My anticipation, I know President Trump and China leaders are meeting on Monday or this next week, it sounds like. So, hopefully something gets done sooner rather than later. Remember, the market does not like uncertainty, and this is a driver, and it's really interesting to me because the market's been fairly strong, and we've had this uncertainty. So I think it's telling me there is a lot of strength in this market, but from a manufacturing standpoint, it's just kind of muddled.
Just to clarify, when you say green good, red bad, so green means manufacturing is expanding.
Expanding,
right?
Yeah. Thank you.
Yellow, it's kind of neutral, and then red, it's contracting.
Correct. Yep.
So where are we seeing a little bit of the red on there?
The red, it's international markets primarily. It's non-U.S. And even specific countries. It looks like Germany, and then you get into India. But this can ebb and flow too. I mean, you look at this from a year-by-year standpoint. Like I said, a year ago, it was pretty green, and it was pretty colorful, positive colorful. Yeah,
exactly. I mean, I think this, even though it's a busy chart, it really does tell a good picture, right? So let's, part of, I think, what's going to continue driving growth as we go forward, and unfortunately, I think this has become a little bit political, but the Fed and Fed policy, and there's been a lot of noise around that. We know last quarter, Ryan, I mean, we live this with our clients, right, where we had the Fed raising rates, the markets responded in a negative way, tough December. And now, as we've headed into the new year, there's expectation the Fed's going to cut rates. Let's talk about the Fed and interest rates.
Yeah. Well, a couple things on that chart. If you look at the blue line, or the blue dots and the triangles, that is basically the Fed governors, them polling and anticipating where they should be. So you have 12 governors, which are regional bank presidents, and then you have 5 board of governors. They poll all 17, and then they make this estimate. And what's interesting to me is they go from roughly 2.38, a pullback, and they're right back there in 2021. When they poll, and I don't have the exact numbers, but it was like 8 of them said we should be increasing, 6 of them said decreasing, and then they go in by 25 or 50 basis points, and it nets out to even. The mean of it is basically even. What's interesting is there's only 10 voting. And so the 10 voting have the control, right? And 5 of them are the board of governors, and then they have 5 others that end up voting. If you poll them separately, you're going to see probably rate cuts. And you could see, actually here we are on Thursday, and next Wednesday is when the Fed will announce whether they cut. My anticipation is they will cut by 25 basis points. We'll probably see one more cut. But what's I think more interesting, you talked about politics, Brad, is they're mandated by unemployment and inflation, but they also look at the world, right? And when we go back to that manufacturing slide, things have softened. We're the giant, and they do worry about what's going, so there isn't a global recession in the back of their mind, and that's really why I think they're going to cut. Probably here, and then maybe again later.
Yeah. So, around this topic, Ryan, first of all, a couple questions, but how closely do you think clients are watching what's going on around interest rates and Fed decision?
Yeah, obviously they're watching it, but probably not the Fed funds rate, right? They're not looking at what is happening on the Fed or the overnight lending. They're looking at what can I get for a CD rate at the bank? What can I get if I'm going out and borrowing money, right? If I'm a manufacturer, like we talked about in the earlier slide, if I own a business and I want to spend some capital, So it's obviously an important thing to think about. But as far as the Fed funds rate, probably not too much.
So one thing that we did see in December when the Fed was raising rates, the impact that had on the short end of the yield curve and money market accounts, cash-bearing accounts. And so that's been a bit of a positive, right? Clients holding cash.
It's been great. It's given us a great opportunity. If we think about money market accounts, they're running 2.2, 2.1, kind of depending on what we want to be looking at. CD rates really last fall, really jumped up to about almost 3% on a 3-year. The downfall is now we've seen a large reduction in that. If we want to go out and find a 1, 2, 3-year CD, it's probably 2.1%. So a lot of clients, in a sense, jumped on that opportunity, right? People get a little bit scared of the market. I have a really good opportunity to just lock some money up at a good interest rate, and they took advantage of that. But now we don't really have as much of that opportunity. One thing I wanted to talk about real quick was interest rates in the U.S., but if we think about interest rates overseas, there's actually negative interest rates, right? We always think we can't go lower, but in a sense, you can go lower. You can have negative, and so just something to think about.
Yeah, and you look at like the German Bund, their 10-year, they don't pronounce it bond, but the German Bund actually is negative, say 20 basis points. I think I looked earlier this week. So they're giving the government to hold on to their money. In exchange, you give say $1,000. I'll do the math real quick in my head, but they're going to get $980 back just to secure their money. I don't know if over 10 years, by the way, I don't know if I'm in for that, right? But what's interesting is in Japan that's happened for decades. Quite frankly, they've had low to zero to negative interest rates, and I'll contend one of the arguments is, you think of it, if you're an institution in Germany or a foundation, large dollars, and you have to have secure money, and a lot of times they would invest in their own country. I think it's a driver of why our rates are so low. I think we're seeing international flows to the U.S., and it's kind of keeping our rates down, and plus a lack of inventory right now. So it's really interesting.
Yeah, a lot of dynamics that are going into that as well. So let's continue with, just give us some historical perspective on interest rates and inflation, looking back over the last many years.
Yeah, and so the real rate of return is really, let's say the 10-year Treasury minus inflation. What are you going to put in your pocket over that 10 years? And that's really what's important here. And you look historically, since 1958 to year to date, there's typically about a 2.34% spread. Right now we're at 0. And we've muddled through really the last 10 years of a 0%. It's a little higher, a little lower, but all in all, it's 0%. But interesting, historically, it's at 2.25%, 2% of a real rate of return. And we just haven't seen that. And even the 10-year Treasury right now, it's 2.05-ish, right in that range. We've ebbed and flowed from 2.7, 3.5 down to 1.75 over the last 15 months. And so, and I say this all the time, one of these years I'll be right where I predict where rates are going to go, but I never am. And so anyway, and interesting too, and the 10-year won't necessarily be it won't exactly move the same way as the Fed funds rate, but it'll be interesting to see when the Fed, if they do lower rates here next week, and what happens.
So this is a key thing we talk to clients about, right? The real rate of return, because we think safety all the time in bonds and CDs and whatnot, but what am I actually going to put in my pocket after inflation? And there's actually risk involved in that, right?
Sure. So, yeah, which ties back to the financial planning that we do as well, and looking at forecasted returns, but also how inflation fits into that as well. Let's shift gears a little bit. We're in the midst right now of second quarter earning reports, right? Corporations, companies are reporting their earnings for second quarter. Not only do they report earnings looking back, but they also give guidance looking forward. So what are some of the things we're hearing now in the midst of this?
I think every time we talk about this, my stats really don't change, which I think is so interesting. So of the companies and of the S&P 500 companies, I think there's been about 120 or something like that have reported. About 78%, I think I read the other day, have actually exceeded analyst earnings. So they've had upside surprise. I think it was like 10% have not met, and then the other have met. So, And it's funny to me how those numbers really never change. So
No.
we've had decent earnings.
And where are earnings coming from? What are the sources that?
Well, usually they come from margin or added revenue. If you look at this slide right here, and you look at how strong we really were in 17 and 18, I mean, and the biggest part of that, quite frankly, was margin, and then increase in revenue. People have had the argument that share buybacks have held, and that in this slide is actually share count. That hasn't really played a big part, but in this, so far this year, we've had 4% earnings growth. The anticipation is roughly around 5%. So we're not going to see the 17 and 22% numbers like we saw in 17 and 18, but 5% I think is just fine.
Yeah. So when we look at earnings and we look at, I think the market has kind of priced in two things. One, anticipating the Fed cutting rates, and then also expectations that we're seeing positive earnings as well. So it's been interesting this week. The market hasn't really done a whole lot as companies reported what's been expected or even exceeding. Where are we at from a valuation standpoint of the market? And that's something we're always looking at. Is the market overpriced, underpriced, priced where it should be?
Right.
What are the valuations looking like?
On the chart through June, you can see the PE was in the S&P 500 anyway, about 16.7 times earnings. It's right at the average for the most part. At 16.19 is the historical 25-year average. Through like the last couple of days, we're north of 17 right now, so we've seen an increase probably in valuation. So it might be getting, maybe a little high, but all in all, I don't worry too much about that. When you start getting to 19, 18 and a half, then we're probably overvalued. But I say this all the time: P divided by E, price to earnings, PE ratio. If that E keeps going up, price should go up in that relation, and then it maintains. A lot of times we'll see the P go up and the E, will have a negative surprise, and that'll hurt.
Yeah.
And that's when the market might pull back.
Right.
What I think is interesting from a valuation standpoint, think of core investments are stocks, bonds, mutual funds, stocks, bonds, and cash. If you look at that last line, the earnings yield spread, and you look at the BAA yield at the latest reading, 1.65%, that's a bad number. So then you got to weigh from a value, are stocks a better value than bonds?
Right.
And BAA means just above investment grade. And I would make the argument that they probably are. I mean, we can compare anything: price to cash flow, price to earnings, price to stocks to bonds. From a valuation standpoint, and relative to bonds, stocks are actually cheap.
Yep, exactly. And but at the same time, you look at the value of the market, but we're at all-time highs in the market. So one of the challenges I think we have is clients sell a business or have cash, and they want to deploy that into an investment strategy. It can be a little scary right now when you think the market's at an all-time high, but if you dig into it deeper, it's really not a bad time to be putting dollars into the market.
Well, we've had valuations much higher than this, right?
Yeah.
So we always get this preconceived notion that there's this dollar, or this, I shouldn't say dollar, there's this number, right? That the number is really driving what I'm actually going to be doing. But once we start digging into the actual numbers, the valuations aren't that bad. We've had valuations much higher than this at much lower. If we use the SP 500, for example, at lower SP 500 numbers, now we hit 3,000 and everyone thinks, we can't go any higher than this. But we were just at 2,500. We were just at 2,200.
Yeah.
There's always a new high.
Right.
Yeah.
Right. Exactly.
I say when you have good markets too, something has to stop it, right? Whether it's a recession or a bubble or whatever. And we touched on this earlier, that I just don't, and I talk to clients about this, don't give me the argument that the market's just too high. I don't like that. Tell me why it's too high. Just because it's a big number.
Right.
Think back to 3-4 years ago when we were at 22,000, 23,000, and they said, well, we're too high at 23,000, and then we're too high at 24,000 on the Dow.
Yeah.
And I'm not saying it's going to go on forever,
Right.
but what I am saying is, from a valuation, and that's how you have to look at it, is value it, and whether it's price to earnings, price to cash flow, however it is, that's how great investors make money.
Right. And that's the point, right? Investing versus trading.
Exactly.
So investors, you think about this next slide. If you look at the stock market since the early 1900s, and you look at, yeah, we've had volatility, but it's a pretty nice little chart there when you look at it over the long term, right?
It's a nice 45-degree angle. Right?
It is, isn't it?
Yeah, and this is a technical analysis, so people that just read charts, and there are people that they don't even know what company they're looking at, and all they'll do is they'll read a chart, say that's got positive momentum, or the trading range is good, or whatever. From a technical standpoint, and you look at a chart like this, and the trend that I see is we have 20 plus years of raging bull markets. And then what's more interesting is we just broke out in 2014. This doesn't go back to 2008. We were still flatlining. We got to even. Then we break out. The point being is, if you're a young investor, you need to be in the market. And I'm not saying 100%. You have to figure out what your risk tolerance is. But if you're in the market, that's how you're going to make money. The other point to this is the gray vertical lines are recessions. So you can have a recession within a 20-year bull market. So anyway, and I'm not trying to make a sales pitch to that the next 2 years or year is going to be great, because I don't know. But what I am saying is, over time, this looks very positive.
And the key there is being in the market, right? Because these valuations can go up and down at any point in time, and it can be short blips. And we have to be in the market at all times.
Yep, exactly. So, we talk about the growth of the U.S. market, stock market, and the run that we've been on. Compare that to what we've seen to international equity markets.
Yeah, and U.S. markets obviously have been strong. PE's moved up a little bit. What's interesting, international just hasn't followed suit, even though this year I think the MSCI equity returns are north of 14% or something like that, ex-U.S., which most of the time we think are great. They just haven't really met up with the U.S. or competed with the U.S. markets. Right now, again, you go back to valuations, that index, the ACWI ex-US, is at 13.2 times earnings, very low. Historically, it's about, the 20-year average is about 4%. Right now, it's got a great dividend yield, the 20-year average versus the 20-year average. So comparing to the US, it's, I think, a good value. Comparing to itself, I think it's a good value. I just, and I'm not saying, again, go all in on international markets. I'm saying, if you're a value investor like Warren Buffett or other notables, Peter Lynch or whoever, think about that. When you see something on sale, think about buying it. Now, there's a lot of issues out there. We've gone through Greece, and we've gone through Brexit. And, I don't know if you noticed on that manufacturing momentum, one of the greens was Greece. And we went through that, I think, 3-4 years ago. So it's turned, and everything cycles. So point being is, international is going to be a hit someday again. I just don't know when.
And I think, Ryan, with our clients, we call it home bias, right? And so clients tend to gravitate toward what they've seen recently, and with the U.S. markets going up, tend to get a little more tilted in a diversified portfolio. Clients maybe want to go a little bit deeper into the U.S. market, but international is an important part of a diversified portfolio.
Well, we get this recency bias, right? So I'm home-based. U.S. market's done great. Why would I put my money anywhere else in the S&P 500? Well, if we go back from 2000 to 2010, the lost decade, if I will, international did great.
And when you mean lost decade, what do you mean by that, just to clarify?
Well, from 2000 to 2009, the S&P 500 on a total return was I think negative 0.9 maybe. It's very slight, but down. So it returned nothing at the end of the day.
10 years.
Over a 10-year period of time, where the international market, I think, was up 216% on a total return basis. And so we need to be disciplined investors. And I think that's the biggest key here is, if I'm changing my tune every so often, am I missing out on the next thing? But if I have a disciplined plan, I probably don't. I'm going to get a little bit of the highs, a little bit of the lows, but I'm going to get the market returns that the market's giving me.
Exactly. So speaking of discipline, we're what we call factor-based investors. So we're looking for a source of returns, premium returns over and above the market over the long term. Where are we at from a factor standpoint? First of all, Ryan, what are some of the factors that we incorporate into our investment portfolios?
Yeah, so probably the two, well, I should say all three.
Yeah.
Value over growth, right? And we talk about this tilt towards value. It's not as big of a tilt as we think, right? It's maybe 52% value, 48% growth, but it's a tilt towards value. It's small cap over large cap. Small companies tend to outperform. I use Bailey as an example a lot. We're a micro company, but we've had a lot of growth, right? We're a good company. And then the last one, momentum. And so those haven't performed where maybe we want them to be in the last few years.
Which ones?
Well, value and small,
Yeah,
for sure. Momentum has, absolutely.
Yes. Yeah.
But they're good to pair with each other. And this comes back to the diversification and discipline.
Yeah. Yeah. So Darren, talk a little bit about what we're seeing from a factor performance standpoint and this chart, what this is showing us.
Yeah, and just Ryan did a good job of explaining what we do, and there's actually numerous factors, and and people are kind of, I hate to say inventing, but they're finding new factors, right? And really what a factor is, it's how do you find an advantage? And historically speaking, like, do you take stocks momentum as an example, stocks that have outperformed, will they continue to outperform versus the underperformers? And simply that's what momentum is.
Right.
And so there's always academics that are doing research on this. We've elected to, and we've looked at a number of adding a number of these other factors to our portfolio, and we haven't done it. There's a number of reasons why we haven't done it. But what's so interesting is when you diversify these factors, you ultimately have a better performing, and you lessen the risk or the volatility in that portfolio. So, I think what's interesting here is it ebbs and flows. We show this quilt slide all the time of asset class returns. Now we're showing it of factor performance, and at the end of the day, we can't predict. So diversify, whether it's multi-factor, and try to lessen your volatility in the portfolio.
Yeah. Which is something we look at every quarter during our investment committee meeting with the folks at Symmetry.
Yep.
So we diversify across multiple factors. We also diversify across multiple asset classes. And so our final slide here, again, covers that. What are some of the things we're seeing from a asset class standpoint?
Yeah, and the whole point of this, like I said in the previous slide, it's very similar but different is, and Ryan was going right down that perfect lane of diversify, right? I mean, that ultimately that's what you do when you're an investor. You buy U.S., you buy international, you buy small, you buy large. The best investors do that according to their plan with their financial advisor, and over time they're going to be fine. And and really our job is to try to manage the risk and make sure they sleep at night and all these other great things. But I mean, that's really what this chart is showing. It's, it's very colorful. I can't predict it, but I can tell you with some certainty that white box is fairly consistent, and that's really what I'm shooting for.
And the white box is really a combination of all the colors.
Yep, good point.
Mixed together, right?
Yep.
That's diversification. The power of diversification really gives us return over the long haul,
right,
but softens that volatility aspect of it as well.
Yep, absolutely.
So let's kind of wrap up with a couple of points here. We said we're diversified across multiple asset classes and factors. Some are more favorable right now than others. We look at things over the long term, but we can't discount short term. And so if you look at our U.S. equity strategy, I think we're up about 17.5% year to date through second quarter.
Right.
So I think our clients that have exposure in that investment feel pretty good about it. I think what's interesting too is our bond strategies are up over 6% year to date too.
Right.
So it's interesting. We're seeing really across the board stocks and bonds having a pretty good year, and likewise our investment strategies are having a pretty good year as well.
What a difference a half a year makes.
Yeah.
I mean, I remember us sitting here doing the fourth quarter recap, and nothing was positive.
Mm-hmm.
Fixed income wasn't, U.S. international, emerging, could go commodities. Everything was negative last year, especially the fourth quarter. And here we are, and we're, our, like you said, Brad, our fixed income, our income sleeves are doing great. Our fixed income sleeves are doing great. Everything is performing like we expected it to.
Yeah. Yeah. And even though, we're investment advisors and we manage about $1 billion now in assets under management, the emphasis for us is planning, right? And so we always manage money in the context of financial planning. So you want to talk a little bit about that?
Yeah, I tell my clients all the time, do you want to be the 80-year-old that ran out of money but he got a 13% rate of return, right? Or the 80-year-old or 85-year-old that got a 2% rate of return but is living life and, more importantly, sleeping really well at night? Yeah. And I think that's the biggest key is let's go back and define what our goals and objectives are. And if we can meet those goals and objectives, it'll tell us what kind of rate of return we need, and it'll tell us how we need to invest. Yeah. And the financial planning is absolutely key. If we get that right on the front end, everything else should just follow. Yeah. And it helps us stay more diversified. It helps us stay in the market longer. You know, one of the things that I get scared about right now is S&P 500 has been easy money for 10 years. And a lot of people think that. Why am I not in the S&P 500? Right. Well, it's easy until it isn't anymore. Right. And that's what, in a sense, scares me with certain individuals that we work with. So.
Yeah. And I'm just hoping I make it to 80 or 85. I mean, that's just my goal. Forget about returns. I just want to make it to that point. So, all right. Well, thank you for joining us as well. And we look forward to seeing you next time on our economic and market update.